Summary of Bank Investing. A Practitioner's Field Guide by Suhail Chandy Weison Ding. Written and narrated by JANKY. Introduction. Embark on a journey with bank investing, where we demystify the labyrinth of bank financial statements. Delve into the art of credit analysis, gracefully navigate the intricate dance of regulations and interest rates, and witness the dynamic spectacle of banking mergers and acquisitions from the front row. Unleash your ability to not only interpret bank metrics with style, but also utilize them as a seasoned pro to steer your investment choices. Ever found yourself bewildered while poring over pages of bank financial statements, uncertain about where to focus or how to unravel the numbers? Ever marveled at those who effortlessly navigate the complexities of bank investing, as if possessing a hidden treasure map? If so, you're not alone. The realm of bank investments, with its convoluted financial metrics and subtle regulations, can resemble a daunting maze. But what if you could transform into the adept guide of your financial journey, armed with the precise tools to confidently decipher this intricate maze? Enter this audiobook, your ultimate guide to unraveling the intricacies of bank investments. From fundamental profitability metrics like return on assets and return on equity to the finer points of credit analysis, the regulatory landscape, and the intriguing world of mergers and acquisitions, we've got it all covered. By the time you reach the end, you won't just be proficient at decoding bank financial statements. You'll also possess the knowledge to evaluate risks, profitability, and growth opportunities. It's not just about becoming a sharper investor. It's about evolving into an empowered individual capable of making informed, confident decisions about your financial future. Chapter 1. Navigating the Maze of Bank Financials. Envision yourself traversing a maze, a complex labyrinth of numbers, ratios, and terms that hold the potential for either triumph or catastrophe on your investment journey. In lieu of a conventional map, your guide through this intricate terrain is the financial statement, specifically tailored to the unique nuances of banks. This is no ordinary maze. It demands a specialized toolkit and a discerning eye for detail. Let's delve into the art of becoming the shrewd guide of your financial expedition by unraveling the intricacies of bank financial statements. To commence, acquaint yourself with two guiding stars in your financial galaxy: return on assets, ROA, and return on equity, ROA, derived by dividing net income by average assets over a defined accounting period, provides insights into the bank's ability to leverage its assets. Meanwhile, ROE, calculated as net income divided by average equity, signifies the efficiency of this leveraging muscle in generating returns. These metrics unveil the fundamental profitability of a bank, making it imperative to scrutinize ROA and ROE when evaluating potential investments. Now focus on an often overlooked but crucial aspect: asset quality. Picture Sarah, an aspiring investor comparing two banks with similar profitability. Despite the apparent parity, Bank A exhibits a significantly higher ratio of non-performing assets, NPAs, to total assets, signaling a red flag. Elevated NPAs imply heightened risk and potential credit challenges. Sarah wisely opts for Bank B, underscoring the importance of scrutinizing asset quality metrics, such as NPAs, to assess a bank's risk profile. Consider the vital element of liquidity, akin to the air essential for survival. Examine metrics like the loan-to-deposit ratio, which gauges the ratio of a bank's loans to its deposits. An excessively high ratio suggests over-leverage, while an excessively low ratio indicates inefficiency. Finding the balance is akin to watering a plant just enough for optimal growth. Lastly, delve into the realm of growth, emphasizing the significance of sustainable growth. While banks, like any business, require growth, rapid loan expansion can be a double-edged sword. If Sarah notices Bank C experiencing a dramatic surge in loans within a short time frame, she should pause to assess the sustainability of this growth. Healthy growth aligns with industry peers, avoiding recklessness. Remember, bank financial statements transcend mere spreadsheets. They constitute the DNA of an institution. Beyond revealing monetary gains, they illuminate the operational intricacies, risks, and long-term sustainability of a bank. By comprehending the key metrics explored, you're not merely deciphering numbers. You're unraveling a narrative that guides you through the maze of bank investing. Chapter 2. Unveiling the layers in bank investing. Having successfully navigated the intricate maze of bank financial statements and embraced metrics like return on assets and return on equity as your guiding North Stars, you're now poised for a deeper exploration. Bank investing, however, is a multifaceted journey that extends beyond the realm of financial metrics and asset quality. Enter the next layer of the puzzle: credit analysis and loan portfolio composition. These elements introduce the nuances, the shades of gray, that add context to what may initially appear as stark black and white numbers. Let's commence with a crucial aspect: loan loss reserves, the funds banks set aside as a precautionary measure for potential bad loans that may default in the future. Strikingly, higher loan loss reserves don't always translate to a positive outcome. While a robust reserve is reassuring, the ideal scenario is one where the reserve is balanced. Banks operate in a dynamic environment where regulations and tax laws evolve. Excessive reserves may indicate missed profitable lending opportunities, while inadequate reserves elevate the risk of defaults. As an investor, your key to navigating this lies in scrutinizing historical trends. A sudden shift in reserve calculations without corresponding changes in regulations or market conditions should raise a flag. Transitioning to credit quality, the lifeblood of a bank's operation, is imperative. Operating on a leveraged basis, even a minor increase in loan defaults can have profound repercussions. Focus on credit quality indicators such as the Texas ratio and net charge-offs. The Texas ratio, calculated by dividing a bank's non-performing assets by its loan loss reserves and tangible common equity, assesses credit risk. A high ratio signals a red flag. Net charge-offs, representing the value of loans unlikely to be recovered as a percentage of the loan portfolio, often indicate deteriorating credit quality. Consider these indicators as your canaries in the coal mine. Their distress signals may herald impending trouble. Accounting changes, too, play a pivotal role. The current expected credit loss model, CECL, designed to enhance the dynamism and responsiveness of loss allowance estimates to economic cycles, can significantly impact a bank's portfolio. Abrupt changes in accounting approaches warrant a closer look. Has the bank adopted CECL? How has it influenced its loan categories? Fully understanding these changes is crucial, as the ripple effects of CECL can permeate a bank's operations, potentially impacting consumer loans. In the expansive tapestry of bank investing, credit analysis and loan portfolio composition provide the essential shading that transforms numerical data into a vibrant, comprehensive picture. By honing in on factors like loan loss reserves, credit quality indicators, and the repercussions of accounting changes such as CECL, you equip yourself to perceive not just numbers, but a narrative that empowers you to make informed, astute investment decisions. Chapter 3. Navigating the regulatory and interest rate seas in bank investing. Embarking on the intricacies of regulations and interest rates may seem like a daunting journey. Yet, unraveling the nuances of the regulatory environment and comprehending the influence of interest rates can illuminate your path in the realm of bank investing. Let's plunge into the depths of factors such as capital requirements, stress tests, and the profound impact of interest rates on a bank's profitability and, consequently, your investment potential. Consider capital requirements as the safety net beneath a tightrope walker. A predetermined level of capital is essential for banks to absorb potential losses and avert a financial free fall. Regulatory bodies, such as the Federal Reserve and the Office of the Comptroller of the Currency, OCC, employ the TAMDL system, evaluating capital, assets, management, earnings, liquidity, and market sensitivity. A robust CAMEL's rating signals effective management and could mark a bank as a promising investment. For you, the investor, transparency is key. Seek out public disclosures of a bank's CAMEL's ratings or indicators that provide insight into its capital adequacy. The more transparent a bank is, the better positioned you are to make informed decisions. Stress testing is more than a mere buzzword. It's a strategic approach to running what-if scenarios. Just as our investor friend Sarah might test her portfolio against a housing market crash, banks conduct complex simulations to gauge their resilience under extreme conditions, such as drastic interest rate changes or severe economic downturns. Keep a keen eye on banks crossing the $10 billion asset threshold, as mandatory stress tests become a regulatory milestone that could significantly impact their trajectory. Transitioning to interest rates, envision them as the ebb and flow of the ocean, impacting all boats, big and small. Rising interest rates typically boost banks' earnings from loan interest, outpacing payouts on savings accounts. Conversely, in a low-interest rate environment, profitability may face challenges. Stay vigilant about Federal Reserve announcements on interest rates. Seemingly mundane meetings can herald changes that significantly impact your bank stocks. For a strategic advantage in the long term, understanding broader economic cycles helps anticipate interest rate movements. Don't overlook the 2018 Economic Growth Act, reshaping the regulatory landscape for banks at specific asset levels like $50 billion or $250 billion. If a bank you're eyeing approaches these thresholds, anticipate shifts in its regulatory landscape and compliance costs. In conclusion, deciphering the interplay between regulations and interest rates isn't reserved for Wall Street insiders. These factors wield a profound influence on the stability, profitability, and ultimately, the return on your bank investments. By staying attuned to capital requirements, stress testing, and the fluctuations in interest rates, you not only become a well-informed investor, but also position yourself for potential success in the dynamic world of bank investing. Chapter 4. Deciphering the Dynamics of Bank Mergers. Congratulations, you've acquired a solid understanding of bank financial statements, credit analysis, and the intricate web of regulations and interest rates. Now let's shift our focus to the broader landscape of the banking industry, unraveling the intricate puzzle of mergers and acquisitions, and the competitive dance that shapes the banking world. Imagine this: a notable decline in the number of bank charters since the 1980s. What does this signal? It's a clear sign that consolidation, the act of merging, isn't just a passing trend, but a long-term trajectory in the banking industry. This consolidation isn't arbitrary. It's propelled by specific elements, such as economies of scale, enabling banks to reduce costs per unit as they expand. Additionally, the escalating burden of regulatory and compliance expenses makes it challenging for smaller banks to shoulder the load. As an investor, what does this mean for you? Keep a watchful eye on banks that might be ripe for acquisition. Historically, investing in a portfolio of potential takeover candidates has often outperformed benchmarks. But there's more to the story than just who acquires whom. It's also about the intricacies of deal structures. Various transaction types exist, ranging from whole bank acquisitions, where one bank acquires everything from another, to FDIC-assisted deals, where the Federal Deposit Insurance Corporation steps in to facilitate a healthy bank taking over a failing one. Understanding these deal types can provide insights into their potential benefits for the banks involved. And let's not forget the critical aspect of post-acquisition integration. A well-executed integration strategy can be the make-or-break factor in the success of mergers and acquisitions. Cultural alignment, technological harmonization, and customer experience management all play pivotal roles in ensuring that the combination of two entities yields more than the sum of its parts. The complexity of the banking industry's M&A landscape isn't just a topic for business journals. It's a dynamic playbook for anyone seriously considering investment in this sector. Mergers and acquisitions are driven by multiple factors, including economies of scale, compliance costs, and the nuances of deal structures. By closely scrutinizing these areas, you equip yourself with the analytical tools needed to make informed decisions. In an industry continually evolving through consolidations and regulatory shifts, staying ahead of the M and a curve isn't an option. It's a necessity. Summary: bank investing is like piecing together a complex puzzle that extends far beyond a cursory glance at financial statements. It involves delving deep into key metrics like return on assets and return on equity to gauge profitability, while simultaneously scrutinizing asset quality and liquidity to evaluate risk. The exploration doesn't halt there. Unveiling the layers of a bank's loan portfolio provides insights into critical factors such as credit quality and loan loss reserves, offering a glimpse into the bank's prowess in managing risk. The regulatory landscape, with elements like capital requirements and stress tests, plays a pivotal role in ensuring a bank's stability. External factors, particularly the ebb and flow of interest rates, directly impact a bank's profitability, adding another layer of complexity to the investment landscape. And let's not forget the ever-evolving competitive landscape of the banking industry, characterized by a notable trend of mergers and acquisitions. This dynamic arena serves as a live playbook for astute investors, offering valuable insights into the industry's strategic shifts and potential investment opportunities. Understanding this diverse array of aspects isn't just about navigating the maze of bank investing. It's about arming yourself with the knowledge needed to make informed and successful decisions in a multifaceted and ever-changing financial landscape. This audiobook summary was brought to you by JANKY. We hope you enjoyed it.